Welcome to my channel. I am Dr. J.K. Sachdeva. Let us understand the debt GDP ratio in the Union Budget 2026, a growth oriented perspective. When we hear the figures related to the government debt in budget speech, the first instinct is often to worry. Words like borrowings, fiscal deficit, and debt to GDP ratio tend to create concern. But economics teaches us something important. Debt is not inherently bad. What truly matters is how much debt exists relative to the size of the economy, how it is used, and whether the economy is growing fast enough to sustain it. That is why the debt GDP ratio, rather than absolute level of debt, is the most meaningful indicator of fiscal health. Let us begin us briefly understanding the overall fiscal framework presented in the budget estimates. The government has estimated total expenditure at 53.5 lakh crore rupees, while non-debt receipts are projected at 36.5 lakh crores. Within this, the center's net tax receipts are estimated at rupees 28.7 lakh crores. This tells us something reassuring. A large share of government spending continues to be supported by its own revenues, not borrowing alone. Market borrowings are estimated at 17.2 lakh crores gross, with net market borrowings of 11.7 lakhs crore rupees through dated securities. These figures may seem large in isolation, but economies must always be assessed in proportion to their GDP and growth capacity. This brings us to the central theme of today's discussion, the debt to GDP ratio. In the budget estimates for 2026-27, India's debt to GDP ratio is estimated at 55.6%, improving from 56.1% in the revised estimates of 2025-26. The significance of this number lies not merely in the level but in the direction. The ratio is declining, indicating that GDP is growing faster than public debt. This is a healthy and reassuring signal. The fiscal deficit further supports the narrative. For 26-27, the fiscal deficit is estimated at 4.3% of GDP, slightly lower than 4.4% of 25-26. This gradual and steady consolidation reflects fiscal discipline without compromising growth. Now let us examine why the GDP ratio must be viewed in a positive developmental context. A key component of government expenditure is capital expenditure, which is in the revised estimate stands at around 11 lakh crores. Capital expenditure creates productive assets, roads, railways, ports, power infrastructure, digital networks, and urban systems. These investments expand the economy's future GDP, therefore improving the debt GDP ratio over the time. In simple terms, when the debt finance growth creating assets, it strengthens the denominator GDP. This is precisely why modern public finance does not advocate zero debt. For a developing economy like India, infrastructure creation requires front loaded investment while the returns accrue over decades. Borrowing allows the economy to grow today while paying over time as income levels arise. To better appreciate India's position, let us briefly place the debt GDP ratio in an international perspective. Many advanced economies operate with significantly higher debt to GDP ratios. Countries such as United States, Japan, and several European nations have debt GDP ratios well above 80%, and in some cases even exceeding 100% of GDP. Despite this, these economies continue to function effectively because their debt is backed by strong institutions, stable growth, and investor confidence. Emerging economies too often operate at higher debt ratios than India, particularly when they are in phases of infrastructure expansion or post crisis recovery. Against this global backdrop, India's debt GDP ratio of around 55 to 56% appears moderate and manageable, especially considering India's high growth potential, a largely domestically financed debt structure, long maturity profiles, limited exposure to foreign currency debt. Another important aspect is credibility and transparency. The consistency between budget estimates and revised estimates demonstrates realistic forecasting and responsible fiscal management. This builds confidence among investors, rating agencies, and global institutions. It is also worth emphasizing that trend matters more than the level. India's debt GDP ratio is on a declining path, achieved not by cutting essential expenditure, but by supporting growth and prioritizing capital investment. From a macroeconomic standpoint, this is the most sustainable way to manage public debt. In fact, a growing economy with moderate debt often performs better than a low debt economy with weak growth. Growth expands employment, raises income, increases tax revenues, and improves the government's ability to service its obligations. Therefore, the debt GDP ratio should be seen as dynamic indicator, not a static constraint. To conclude, the budget's fiscal numbers reflect a balanced and forward-looking strategy. The growth reduction in the debt GDP ratio, stable fiscal deficit, and strong emphasis on capital expenditure together indicate the public borrowing is being used as a development instrument rather than viewing debt with apprehension. It is more appropriate to evaluate its purpose, productivity, and sustainability. In that case, the current budget position debt not as a burden but as a bridge between today's needs and tomorrow's growth. India's fiscal story, as reflected in the debt GDP ratio, is therefore one of the confidence, continuity, and long term economic vision. In comparison of other countries, India's debt to GDP ratio of around 56% appears moderate and manageable, especially for a fast growing economy. What makes India's position stronger is not just the level of debt, but the fact that ratio is on a declining path, supported by robust economic growth and strong focus on capital expenditure. This comparison clearly shows that debt, when aligned with growth and development, is not a weakness but a common and widely used instrument of economic policy across the world. Thanks for watching. Please subscribe and share. Thank you very much.
Always share the videos of Dr. Sachdeva to your friends who are interested in data analysis.